If I buy a house for $200,000 today, most of the time I'm looking for properties at the worst case scenario at 70% of the fair market value. Now, one of the things we do is we leverage our investors' money. Our investors' money is actually put into a fund, and Rick is going to talk about that briefly in a few minutes. But that fund, which is, although it's a private placement, anyone familiar here with a private placement? Yeah, we have a handful? Yeah? Okay, so we control the money, and in this fund, what we want to do is we want to leverage the money. We want to use the least amount of the capital so that our return, our cash-on-cash return is maximized. So we leverage the money with a loan at 65%. So that ends up being, we get a loan at around 46% of the actual market value of the property. Now, with let's say $1 million, we're able to leverage our money and maximize our purchasing abilities. If you had $1 million in your pocket today and you wanted to purchase inventory at $200,000, that's about 4 properties per cycle, right? $200,000 each, plus rehab and other costs, you'll have a few $100,000 left, over $100,000 left. So you can buy 4 properties, but you're using all of your cash. You're not leveraging your risk. What we do is we leverage risk. And we're not talking about leveraging risk like the Wall Street people were doing a few years ago, that they're so over-leveraged and they created this mess. In fact, we're talking about risk with a tolerance that is going to protect you in case there's another collapse in the real estate market. At 46 cents on the dollar, you're pretty much safe. I don't see the market crashing 50 cents on the dollar in order to lose all of your equity. So by leveraging, we're able to turn that $1 million into over $2 million. Okay? And that's how we acquire properties. Now, from these residential flips, the net profit that is generated as you turn over these 9 properties is put back into the fund. Now, what I talk about the net profit is, when you buy a property, what you're looking for is your total purchasing price, your total acquisition cost, and that includes all your escrow fees, your title fees, your loan fees, and all of that. That gives you your net, right? Now, from there, that's how much you're in for on this investment. You have your resale net as well. So that's going to include your commissions. It's going to include all of your loan, all of your fees for title, escrow, and that's going to give you your net. And this looks something like this, for example. $200,000, it gives you a total acquisition cost of about $209. On the other side, when you sell it, the residential resale is going to give you a net of about $248, buying at the ratios on the previous screen, which is around 70 cents on the current market value. So what you do here is you take your net from the sale minus the purchasing cost, the total acquisition cost. That gives you your profit. Well, there's other expenses, and those other expenses is rehab. You have a debt service cost that you have to cover because you're carrying a loan. So in this particular scenario, your total revenue from the net is about $38,000. Then you have to spend construction, and I'm probably exaggerating on construction here. I'm putting $15,000. I really don't recall a construction that has cost me that much recently, unless it's some major structural damage. Then you have debt service expenses. So here, you're probably netting about $21,000. Now, if you look at the cash on cash, that's about 10%, right? Because you would buy $200,000 worth of inventory, and after your cost, it's about $209. So you dump from your wallet $209,000, and you're going to get $21,000.